Okay. Good day. I welcome you to Java Console platform once again. So today we are coming to continue from where we ended our last session on cash flow statements. In the last sessions, we look at the meaning of cash flow statements, the components of cash flow statement, and then the format of cash flow statement. So today we are going to solve practical questions on cash flow. And I read the question. The following are the balance sheet of Agama Limited as at 31st December 2007, 2008. So, fixed assets, plant and machinery for 2007, 250,000, and then that of 2008, 215,000. Motor vehicles for 2007, 100,000, and then 2008, 140. Investment 2007, 220, and then 2008, 345,000. And then for current assets, we have stock for 2007, 150,000, 2008, 157,000. Debtors 2007, 120,000, and then 2008, 96,000. For bank 2007, 65,000, 2008, 81,500. For cash 2007, we have 100,000, and then 2008, 64,500. And then for finance by aspects, capital 2007, 700,000, 2008, 755,000. For net profit 2007, 105,000, and then 2008, 126,000. Drawings 2007, 50,000, 2008, 76,000. Long-term liability, we have loan 2007, 150,000, 2008, 200,000. Current liabilities, we have creditors. That's the only current liabilities given. 2007, 100,000, 2008, 94,000. Additional information. During the year 2008, motor vehicle costing 60,000 was acquired. An investment cost 20,000 was sold for 24,000. You are required to prepare cash flow statements for the year ended 31st December 2008. So first, we write the name of the organization. That's the Agama Limited. Agama Limited. So we start with cash flow from operating activities. Cash flow from operating activities. And then the first item will be net profit before tax. Net profit before tax. And then from the question, the net profit before tax has been given to us as 126,000. So net profit before tax 126,000. There is no any interest. So we will proceed with adjustment for non-cash item. Adjustments for non-cash items. Then from the question, The only non-cash item given the person is depreciation. Given is a depreciation. And then that's how we calculate for depreciation. Okay, so after recording the net profit before tax, there is no any interest payment, so we proceed with adjustment for non-cash items. And then the first item that we record under adjustment for non-cash item is. So for depreciation, the accumulated depreciation was not given to us in the person. In the person, we were given the net book value straightforward. So it is up to us to use some ways and means to get the accumulated depreciation. Or it is up to us to calculate for the depreciation charge for the year. And we were given two assets. That's plant and machinery, and then motor vehicle. So let us do some workings to get our depreciation charge for the year. So plant and machinery. So plant and machinery are assets, and then assets are fundamental balance. So it means the plant and machinery value for 2007 will be the opening balance, which will be recorded at the debit side. And then it is 250. And then the closing balance, which is 215. So suppose the closing balance, brought down will be here, and then the carry down will be here. So we report the carry down straightforward. So the carry down will be 215. 215. 215. So it means the difference between the opening balance and then the closing balance is the depreciation. The depreciation charge on the plant and machinery, which is 35. 35. We have reserved this also to 35. So this 35 is the depreciation charge on plant and machinery. And then for motor vehicle, we use the same procedure to get our depreciation charge on motor vehicle. So for motor vehicle, the opening balance is 100,000. So let's reserve 100. And then the closing balance is 1/4. 1/4. But in the additional information, it has been stated that during the year, motor vehicle costing 60,000 was applied. So it means organization bought additional motor vehicle which values 60,000. So whenever organization bought motor vehicle, increase the value of the motor vehicle that they will have. So you will debit the motor vehicle account to the 60,000. And then the difference between the debit side and the credit side will be the depreciation charge on the motor vehicle. So the debit side will give us 160 and the credit side is 150. So the difference will give us 20, which will serve as the depreciation charge on the motor vehicle. So the total depreciation charge for the year would be that of plant and machinery, which is 35, plus that of motor vehicle, which is 20. So the total depreciation charge for the year will be 55,000. So that's how they consider that to use to calculate the depreciation charge for this particular person. And also, in additional information, it was stated that investment for 20,000 was sold for 24,000. Investment for 20,000 was sold for 24,000. So the cost of the investment is 20,000, and then it was sold for 24,000. It means since the proceeds that we receive from the disposal of the investment exceed the cost, it means the organization has made profits on investment of 4,000. Is the difference between the cost and then the proceeds. And then since profit on investments, since profit on investments is not a operating activity, but in the preparation of the trading profit and loss accounts, we added it to our gross profit to arrive at the net profit before tax. So we will less profit on investments. So profit on investment. Profit or less than 4,000. Or we sum up these three figures to get operating cash flow before movement or changes in working capital. So operating cash flow before changes in working capital. WC means working capital. And then the figure will be 177,000. So after getting your operating cash flow before changes in working capital, you proceed with changes in working capital. So changes in working capital. So for changing in working capital, we analyze either there is an increment or decrement in our current assets and then our current liabilities. So the first current asset given to us is stock. So for stock, 2007 is 150,000 and then 2008 is 157,000. So since the 2008 stock exceeds 2007, it means that there's an increment in stock. So the difference between 150,000 and 157,000 is 7,000. So increase in stock. So the difference between 157 and 150. And then whenever there's an increment in stock or whenever there's an increment in current assets, you will let for minus 7,000. The next current asset is debtors. So for debtors, 2007 is 120,000 and then 2008 is 96,000, means there is a reduction in debtors figure. So it means you have received money, so you are. And then the difference between the two figures will give us 24,000. So decrease in debtors. That's the difference. That's the difference between 120,000 and 94,000. So that's the decrease in debtors. That's 24,000. And then the next current assets are bank and cash. They are the cash and cash equivalent. So for cash and bank, we consider their increments and decrements. So we proceed with current liabilities. And then the only current liability that we have is creditors. So for creditors, 2007, 100,000, and then 2008 is 94,000, means there is a reduction in current liability. So it means there is a reduction in current liability, that's the current asset. So it means you have made payments, so we will less the reduction in the creditors value. So decrease in creditors. Decrease in creditors. That's 100,000 and then 94,000. So the difference will be 12,000. So we are done analyzing the changes in working capital. So we will sum up the figures together with the operating cash flow before changes in working capital. And then we get 1,800 1800. 1800. That's a cash flow from a group. So here means cash flow. So cash flow from after getting your cash flow from operation, then you adjust for tax paid and then interest paid. But from the question, we didn't pay any tax and then we didn't pay any interest as well. So it means this figure will also serve as a net cash flow from operation. So that's our net cash flow from operation. 18800. So net cash flow from operation activities. We are done with one segment of it. So we proceed with investing activity. That's a cash flow from invested activities. So CF, which means cash flow. So cash flow from invested activity. In additional information, they said the company acquired motor vehicle costing 60,000. So when you acquire motor vehicle, it means it's a result in reduction of cash and cash equivalent. So acquisition motor vehicle 60,000. So since it's a cash outflow, it will be a negative figure. And then there was investment which cost 20,000, but you sold it for 24,000. So the 24,000 was served as a proceed from the investment. So means there will be a cash inflow of 24,000. So recognize that value. So proceed from investment 24,000. Proceed from investment which is 24,000. And then we also analyze we analyze the investment to see if there was further investment during the year. So for the investment figure, at the beginning of the year, that's investment. Investment is an asset, so it's asset line. So any transaction that will increase your investment will be debited, and any transaction that will increase your investment will be credited. So at the beginning of the year, open balance for investment, that's the 2007 balance is 220,000. And then at the end of the year, that's 2008, the closing balance for investment is 345. So the drawdown will be here and the carry down will be here. So this will be our carry down, 345. And then investment costing 20,000 was sold. Investment costing 20,000 was sold. So if you sold the investment to reduce your investment, so it will be here. So the difference between the debit side and the credit side would be further investments that organization need. And then the difference will give us so 345 plus 20 will give us 365. And then we less it from the 220. We less it from the 220 to give us 145. So it means during the year, the organization invested 145. Since we are investing an amount of 145,000, it will reduce your cash and cash equivalent. So you put it in the bracket. Acquisition of investment 145,000. 145,000. So you are done with the investing activity. So we find the total figure for the investing activities, and then we get negative 181,000. 181,000. For the next will be a cash flow from financing activities. Cash flow from financing activities. And then from the question to the organization didn't pay any dividends, and then there is no any interest to you as well. So there was a drawings for the year, which is 76,000. 76,000. So when the owners of the organization take something from the business, it will reduce the cash and cash equivalent. So drawings. But one thing about drawings, although there was a drawings for 2007 and then drawings for 2008 as well. But for drawings, you won't find the difference. You only record the actual drawings for that particular year. So since you have a better cash flow for 2008, drawings will be the 2008 drawings, which is 76,000. So drawings 76,000. And then the next item that will fall under financing activities is loan. Loan for 2007 is 150,000, and then 2008 is 200,000. So it means there was a further loan of 50,000, and then since we have received a loan of 50,000, this will increase our cash and cash equivalents. So loan, that's the difference between 200,000 and then 150,000. So you get 50,000. Get 50,000. So that's all for financing activities. So you find the difference between the 50,000 and then the negative 76,000. And then this will give us negative 26,000. So negative 26,000 is a net cash flow from financing activities. So after we have calculated for net cash flow from operations, investments, and then the financing activities, we find the total for the three segments. That's the operating activities of 188,000, investing activities of negative 181,000, and then financing activities of negative 26,000. And then their total will give us changes in cash and cash equivalents. So changes in cash and cash equivalents. Changes in cash and cash equivalents. And then we get a negative figure of 19,000. So after getting the changes in cash and cash equivalent, we will add cash and cash equivalent at the time or at the beginning of the year. So cash and cash equivalent after. So from the question 2007, we have bank of 65,000 and then cash of 100,000. So we add up the we have the open balance for cash and bank, which is 60,000 plus 100,000, and then we get 165,000. And then the difference between the changes in cash and cash equivalents and then cash and cash equivalents start to leave us the cash and cash equivalents at end. So since this is a negative, let's say from the cash and cash equivalents at start. But in case the changes in cash and cash equivalent is taken figure, we will add it. So the difference between the two will give us 146,000. That's cash and cash equivalent at end. That's 146,000. So you can cross-check to confirm that whether what you have done is correct or wrong. Is correct or wrong. So this is how you do. So from the balance sheet, 2007, for bank, we have a bank balance of 81,500. And then that of cash is 64,500. So if you add the two, we will get 146,000. Then let me show you this easier way to know whether your changes in cash and cash equivalents is correct or is wrong. So this is how we do. Mostly cash and cash equivalents are starts, and then cash and cash equivalents at the end will be given to you in the balance sheet. So from the question that we just saw, cash and cash equivalents are starts. At start is 165,000. And then at end is 146,000. So the difference between your cash and cash equivalents at start and then at end will be your changes in cash and cash equivalents. So at the beginning of the year, you're having the cash and cash equivalents of 165,000. And then at the end, your cash and cash equivalent is 146,000. It means that you have spent some of your cash at the beginning of the year. So it means the changes in cash and cash equivalents will be a negative figure. That's the difference between 146 and then 165, which is 19,000. But let's assume that at the beginning of the year, your cash and cash equivalent is 10. And then at the end of the year, your cash and cash equivalent is 25. So it means the changes in the cash and cash equivalent will be the difference between 25 and 10, which will be positive 15. So this is the easier way to calculate for your cash changes in cash and cash equivalent. So we are done solving our first question. We end today's sessions here. In the next session, we'll continue by solving another practical question. See you in our next session.